In this video, I'm going to walk you through how to evaluate an apartment building. There are top metrics that you need to know before making that big purchase. Let's dive in. My name is Stacy. Welcome to the RMFI Academy, where we empower working professionals to achieve financial autonomy through multifamily real estate investing. Let's get started with the most important metric, that is net operating income. Now, you might hear people say NOI. That's what they're referring to, net operating income. The net operating income is effectively how a building performs, just like a business. So if you think about it from a standpoint of any business, there's revenues that come in, there are expenses that go out, expenses that are required to operate the business. Well, net operating income is no different. The revenue that we're talking about is going to be things like rents, possibly late fees, application fees, pet fees. If there's anything else that you're doing to supply a service to the tenants, that revenue gets captured in revenue, all right? Expenses are everything that it takes to operate a building. So property taxes, insurance, maintenance, property management. Okay, let's talk about how you calculate it. This one, it's pretty straightforward. So if you're gonna do revenues minus expenses, let's just say we're purchasing a building that has $100,000 worth of revenue every year, okay? That'd be your top line. And let's say it has $45,000 of expenses. That means the net operating income would be $55,000. 100,000 minus 45,000. So 55,000. That's how the building performs, not including any kind of mortgage payment or debt service. Because frankly, those things are going to be different investor to investor. When investors are making the decision about buying this property versus that property, net operating income is going to be a huge part of that, because some buildings have the ability to be a lot more profitable than others. It can depend on the area, what are the market rents, just what's going on in the economy in that particular area. So net operating income is literally the way that investors will assess the value of a property when it combines with cap rate, which we'll be talking about a little bit later. All right, let's talk about market cap rate and cap rate of a performing property. So cap rate is kind of similar to a return on investment, and let me explain. So every market has its own cap rate, which is short for capitalization rate. It effectively represents what investors are willing to spend on a property in a certain area to get a certain return. So I know that doesn't make a lot of sense. So let me give you some number examples. So if you were investing in, say, Hartford, Connecticut, right? And let's say that the market cap rate there was 9%. What it effectively means is that investors who are buying properties in Hartford, Connecticut would expect that it's going to provide a 9% return on investment in order for them to put their capital there. So this is a little counterintuitive, but the higher a cap rate is, the less desirable a market is considered. Now, that doesn't mean it's a bad market for you to invest in, because the other side of it is the higher the cap rate, the higher the cash flow. So it's just when you look at markets like, San Diego, California, you know that there's going to be appreciation over time, where smaller markets, maybe that aren't so desirable to go live in, the prices aren't like shooting through the roof. They're not as desirable, but they're going to cash flow better. Now let's talk a little bit about just cap rate, right? That was market cap rate, what people expect to receive based on a market and based on desirability. Now cap rate, when you're talking about a specific property, you take the net operating income, which we just talked about how you calculate, and you divide that by the purchase price. So for example, if I had a net operating income of $55,000 and I was buying a property for $1 million, I would take that $55,000, divide it by the $1 million purchase price, and it would come up with a percentage, and it would be 5.5%. That 5.5% is the cap rate. So that higher amount of net operating income and that higher cap rate is going to produce more cash flow. And cap rate is one of those things that just boggles people's mind, because it really does the exact opposite of what you think. So high cap rate means less desirable market, but more cash flow. So really, who is it less desirable to? Because I'm all about that cash flow. But it really depends on what strategy you're going to be using. If your exit strategy was to make improvements to the operations, increase the net operating income, and then sell it to another investor, then being in a market with a lower cap rate is actually going to have a better impact for you. Being in a market with a lower cap rate is going to have a bigger impact on the value of your property, and it's going to make your property worth more. Wait, what? How is that possible? So my property in a 5.5% cap rate is going to end up having a higher value if I increase the NOI? Like, how is that? So let's talk about some numbers on that. All right, let's start with a 10% cap market. Let's say that I go in there and I find opportunities to increase the net operating income by $1,000 a month. So the first thing we do is we multiply that by 12 because we always annualize everything when we're talking about apartment buildings. So now we're talking about $12,000 a year increase in net operating income. Well, that's cool, the extra $12,000, that's not bad. But the bigger impact when it comes to apartments is what it does to your value. So if we make that $12,000 a year improvement to the property and it's in a 10% cap rate market, the way we calculate it is by taking $12,000 a year, that was our increase, and dividing it by the market cap rate. So divide it by 0.10 or 10%. Well, what does that give you? That gives you $120,000. What that means is if you make an improvement of $1,000 a month in a 10% cap rate market, you're going to increase the value of the property by $120,000. First of all, that's amazing. Why everybody isn't doing apartments is absolutely beyond me because there's obviously so much money to be made in it. Now let's contrast that to a 5.5% market. $12,000 a year increase in net operating income, and we divide that by the cap rate, the market cap rate. So that would be 0.055. That's how we would represent 5.5% in a calculator. Okay, so $12,000 divided by 0.055. What does that come out to? You want to check your calculator and see? You're going to be excited. It comes out to over $218,000. So it's interesting because the fact of the matter is, in a 5.5% cap rate market, it's not going to be a ton of cash flow. But when I do make improvements to the building, it's going to have a bigger impact on the value. And this is really why there's no right or wrong when it comes to what cap rate, what markets you invest in. It really has to do with what is the strategy. All right, let's talk about how does cap rate help investors decide between this property and this property. It really just goes back to that same $55,000 example, right? If I have $55,000, and let's say we're talking about the same market. So let's say there's some market cap rate and it is whatever it is. And an investor is looking at two different properties. One only has a net operating income of $55,000, but an asking price of $1 million. The other has a net operating income of $100,000 and a purchase price of $1 million. So one has a 5.5% cap rate, one has a 10% cap rate, but it's the same market. So it's not about the market cap rate being higher or lower, it's the property itself. So if the investor's goal was to maximize cash flow, it's a no-brainer. They're obviously going to go with the one that has the 10% cap rate. All right, the next key metric is cash flow. Cash flow becomes very simple once you understand net operating income. So the only difference between net operating income and cash flow is debt service. So if you've been watching videos, you probably already know what debt service means. If you're new to this channel, debt service is effectively your mortgage payment. So in the world of multifamily, since we speak of everything on an annual basis, you would effectively take your monthly mortgage payment, multiply it by 12 to get your annual debt service. So you have your annual net operating income minus your annual debt service equals your cash flow. Your cash flow is basically what is left over after paying all of the expenses and paying the mortgage. That's the money that is to you either savable if you want to put it in the bank and save it, or spendable. Or if you want to take that money and put it back into the property and improve it, then you can do that too. But basically cash flow is that net to you. And one of the things I've always found very interesting about cash flow, when you're buying rental properties, you effectively have your residents, your tenants, your clients buying the property for you. Because if you're running your numbers correctly and safely, you'll have positive cash flow, right? So if you are paying your mortgage payment every month and you still have money left over in cash flow, well, how did you make that mortgage payment? You made it from the net operating income. Well, where did the net operating income come from? It came from the revenue of the property less expenses. Well, where did the revenue come from? It came from the tenants. So basically the tenants are paying rent, you're using the rent to pay the mortgage, and then there's still money left over. That means your tenants are literally buying the property for you. So like there's just so much benefit to investing in multifamily properties. It's just a complete game changer because you're using your knowledge and your savvy and your wisdom and your education to create an asset that pays you for life. Now, I feel like it's a little bit obvious, but in case it's not, let's talk a little bit about the importance of having positive cash flow. So it seems like, well, of course, but here's the thing. When I was a new investor over 20 years ago, I would invest sometimes based on what I thought a market would do. So I was investing for appreciation. So there were some times where I buy a property and it had, I wouldn't buy anything that had a huge negative cash flow, but sometimes it had a little bit of a negative cash flow. And I knew that going in. And I was so excited, I didn't care because I'm going to make so much money because the market's going to appreciate. That is the absolute worst thing that you can do. I didn't know that back then. I didn't have a mentor to teach me the right way to do it. So I just kind of had to learn from the school of hard knocks. You never want to bank on appreciation. Even if you think a market's going to go up, the reality is there's so many things that are outside our control. We can never truly predict what's going to happen in a market. So even if you are hopeful that the value of the property is going to go up, what you need to do is evaluate it for cash flow and make sure, even if the property never went up by $1, that the property still pays for itself and some. So you always need to have reserves. All right, how do you calculate cash flow? Let's just say in the example that our debt service was $30,000 for the year. If we have the net operating income of $55,000 and we have debt service of $30,000, we simply take $55,000 minus $30,000 and that equals $25,000. So we've already paid the mortgage. We have $25,000 left of net spendable cash flow. So to break it down, you got revenues minus expenses equals net operating income minus your debt service equals your cash flow. And look, here's the thing. It's really critical to your long-term success that you evaluate deals for cash flow and make sure that there is sufficient cash flow to take care of not only the fun parts of having cash flow coming in, but when something happens at a property that you weren't expecting. And look, I don't want to sit here and tell you, oh, everything will be fine. Look, this is real estate, so you never really know. The most important thing that you can do that allows you to sleep at night and takes care of the sustainability of your investment is making sure that you always have reserves. But if you don't have a good amount of cash flow coming in, then where are you building those reserves from? So make sure you always have a good, solid, positive cash flow. I know we're talking about a lot of numbers today. There's obviously so much more to apartment investing. And one of the things that we did for you is we created a curated playlist of masterclasses that we've done over the years. We took our 8 best ones that we feel will help new investors the most, and we put it on a website for you. It's totally free. It's our gift to you, but go ahead and feel free to binge watch that. You can just go to www.warriorsofwealth.com. You'll put in your information and you'll have access to watch all of those anytime you want. All right, let's get a little bit more into the nitty gritty. So let's talk about occupancy rate. So your occupancy rate is simply the percentage of units that you have rented out. So I'm gonna use a 100-unit property as an example, though I'm telling you right now, if you're just getting started out, forget about 100 units. Focus on your first 10-unit property. It's beautiful. But for the purpose of examples like this, it's a little bit easier to do the math. So let's just say we have a 100-unit property and we have 95 of those 100 units tenanted. There's people in there, it's performing. That means we have a 95% occupancy rate. So why do we care about having a high occupancy rate? Well, gosh, many reasons. One, our net operating income is going to be higher when we have higher occupancy, which means our cash flow is going to be higher when we have high occupancy. And frankly, the other thing that's really important to think about that doesn't necessarily impact you directly, but your lender is going to want to see that the property is performing. Well, why do they care? You're paying the same mortgage payment every month. Because if there starts becoming less and less and less tenants, that starts to threaten your ability to make the mortgage payment out of the net operating income. So lenders will become very nervous if they see that your occupancy is going down, down, down. So there's every reason in the world that you want to keep your occupancy high. All right, so let's tie in occupancy with a property's desirability. Let's say we're operating in a market where the average occupancy rate is 90%. All right, so like across the board, that's the average. And let's say that your property is at 95%. Interesting, why is yours 5% higher than the rest? Well, that would speak to the desirability of your property. So is it that you have fantastic curb appeal? So when people drive by your property, they're like, oh, let me go check that place out. Or is it that you have great amenities? Like, what is it about your property that has you at 95% when the average for the market is at 90%? So when you are evaluating a property to buy, or really your own property that you own, looking and comparing to what's going on in the market is going to give you an idea of how are you doing, or how's that property doing. So the opposite is also true. If the average occupancy is 90% and your property is at 83%, like, what's going on? What needs to change? What needs to improve for you to get to a point where you're at least the same as everybody else in the market? And ideally, I'd love to see you above that. Now that you know how to evaluate an apartment building, let's help you understand how to find the right property, how to manage it, and what major pitfalls to avoid. I made a whole series of videos that go deeper into each one of these topics. Click the video that's on your screen right now, and I'll see you there.